There are three things we know about the next stock market crash. One, it's inevitable if history is any guide. Two, it could be a rare opportunity to accelerate your portfolio's growth. And three, sadly, most investors won't be ready to take advantage of it. So what can you do today to put yourself in the camp that prospers? Well, we've got a veteran investor standing by, ready to share his preparation playbook. You're watching Inside Investing. Hello everyone, welcome to another edition of Inside Investing, the show that helps you level up your financial knowledge and sharpen your investing skills. Presented to you by TD Direct Investing, named Canada's best online brokerage by the Globe and Mail for 3 straight years and counting. I'm your host, Rob Moise. There's been a ton of anxiety about the next stock market crash among everyday investors, particularly earlier this year, and that's why I'm glad to be bringing back a calm, cool, and collected friend of the show to help us prepare for it. Joining us is Craig Stevens, founder of the investing blog Retire Before Dad. Craig has been investing for over 30 years and writes about his goal of retiring at age 55 before his dad did. Craig, welcome back to the show. Great to have you with us.
Thanks for having me again.
You know, I knew I had to have you back on the show here, Craig, because you wrote this fantastic blog post about preparing for the next financial crisis while times are good. It certainly hasn't been something on many people's radars until we had those jitters earlier this year. And all of a sudden, people started thinking here. I'm curious, was that what inspired you to write this piece when you did?
Actually, I wrote this for the first time, I think, back in the COVID era. And when that crisis was happening, and it was a crisis at the time, but that reminded me back into 2007 and 2008 when the real big financial and real estate crisis hit the U.S. And I was not ready for that crisis. I had taken steps to make myself more vulnerable headed into it. I had bought a brand new condo and I overpaid for it and I didn't put a lot of money down. I just really wasn't in a position to to invest in that condo and to buy that. And headed into that crisis, it just turned sour. And looking back on that, there were some steps I could have taken to really not make myself so vulnerable at the time. And the ensuing years from that crisis, there were lots of opportunities, but I wasn't able to take advantage of them because I was still trying to clean up my mess that I made leading into it. And that really stemmed from my personal economic situation improving. And when it improved, I took those steps to go into further debt and to put myself at more risk for a crisis, which I didn't think was coming, but we never know if it's going to come. We never think it's coming. And I just made myself vulnerable. And I was reminded of that in the COVID crisis. And then again, in the early 2025 during the tariff announcement, and that sort of threw some investments into a turmoil at the time, and we've recovered. So things are okay. It wasn't as big of a crisis as we feared.
Yeah, I mean, it was certainly a good time to refresh people's awareness of these need for preparation here before something big happens here. I'm kind of curious, how anxious are you that the next financial crisis could be coming soon? Because a lot of investors thought, oh goodness, the tariffs are here earlier this year. Here comes the big crash, and then it didn't, and we're back at highs here. Where's your anxiety level right now?
I'm not anxious. This is not something I think about or try to predict. There are people out there that are going to predict the next market crash. That's not something I think about. I don't know when it's going to happen. I don't think anybody knows when it's going to happen or how it's going to happen. So I don't lose sleep over it. A big part of that is I put into place some habits over the last decade or more that try to make myself less vulnerable to the type of market event that could get really scary. And just setting my situation up, my personal finance situation up to be able to endure that type of event if it were to come, and it could be next year, it could never come. But what we know is that they usually do come and get us, and when they do, it's always a surprise. And then once you know it's there, once you know the severity of it, it's too late to make any adjustments.
So, I mean, can you expand on that thought a little bit? Because, as you say, like, nobody knows exactly what's going to trigger the next financial crisis or when it's going to occur. Why do you feel it's so important for all investors to prepare well in advance of the next financial crisis when times are good, rather than just trying to adjust when the crisis does happen?
Well, this is not just for investors. This is really for everybody. When I wrote that piece, it was about economic times, not so much market times, right? And so when something happens, when there's a economic event, it could be a geopolitical event, it could be a personal crisis. You can sort of think about how you're vulnerable by just envisioning, say, a market crash or one of these things happening. And what we can do personally is just look at our personal financial risk and think about how we could set ourselves up to tolerate the kind of market event that would happen, or again, it could be a geopolitical event or something else that we're just not sure what it is. What are the steps that you can take personally to reduce your risk and to reduce your vulnerability?
Mm-hmm. And as we're showing, if you can take advantage on screen there, that chart shows us that if you're ready to invest after the markets go sideways, you could really benefit for it, but you have to be ready for it. And, Craig, the little tongue-in-cheek comment here, but, we've seen a lot of billionaires buying, bunkers in Hawaii and stuff like that. Is that part of your financial preparation process?
No, I'm not buying any bunkers. If I could afford it, I don't think I would. No. For me, it's more about personally, looking at my situation and finding ways to reduce my personal risk if something were to occur. I just remember how I felt back in 2007 and 2008. Not only did I feel like I was vulnerable to the market, my money was crashing. I was lucky enough to keep my job. But when these things happen, a lot of people lose their job and they struggle for a long time. A lot of people just survive. And then there's this third category of people who actually take advantage of the crisis or whatever it is, or they see opportunities and they've prepared themselves to take advantage of it, either from an investment standpoint or just from their personal business or their lifestyle. So there's just different ways you can look at this, and it really comes down to when the crisis arrives, it's too late. So how do you make the adjustments leading into whatever event's going to happen? And by the way, if an event doesn't happen and things keep going well, then these kinds of things that you can do to prepare for it are still very good for your personal financial situation.
Yeah, certainly. I mean, there's no substitute for peace of mind, right? Knowing that you're ready for whenever the moment does come. So let's get into your process here. You have a 4-step process for preparing for the next financial crisis. We're going to hear all about it here. And for those in our audience who want to get in on that conversation, maybe you have a question for Craig too, make sure you submit them to us. If you're watching on Webbroker, you can use the chat box to send your questions to us. If you're watching in our broadcast platform, use the questions and comments box. And if you're watching on our YouTube live stream, you can click on a link in the description. It's going to take you over to our broadcast platform, and that's where you can ask your question. All right, Craig, let's get to step 1 in your process here, and that is to reduce your personal financial risk. So can you just give us some clarity on what you mean by personal financial risk and what are some of the things that you could do to reduce it?
Sure. So certainly having insurance in place, health insurance, home insurance, disability insurance, just the basics for insurance are there for these reasons, to protect you in the case that you need them. So certainly keeping your insurance in place. Debt is a big one. And so, as I mentioned, I had bought this condo that I couldn't afford back in 2006, and it created this very large payment that a big chunk of my income was going toward. That can be a home, or it could be a car, or it could be a consumer debt. And we all know that consumer debt is bad and high interest debt is bad. So of course you want to pay off your high interest debt or not have any to begin with. But it's more about cash flow as well. I mean, if you're going to have a $1,000 car payment and a $2,000 mortgage payment, and you make maybe $4,000 a month, then you have a cash flow problem. So it really comes down to some of the basics of personal finance, where you're not overspending on things like the home and the car, right-sizing the home for you. And so when things are going well, instead of thinking about, oh, how do I borrow more to get more, you should be thinking more about how can I borrow less so that I'm less vulnerable heading into this. While times are good, I don't need to borrow. Another thing to think about is income diversity. So when these problems hit the financial markets or the economy, things start to happen, like people lose their jobs, companies lay people off. So where are you in your job security? Are you in a position that is very secure? Maybe you work in medicine and people need your services, but there are jobs that are less secure. And how well do you know your job and your position? Some households have 2 incomes. So if you have a wife, a spouse working and you're working, then that helps to alleviate some of the vulnerability as well. And then there are other ways to earn money, like investment income. We talk a lot about investment income and how that can supplement your primary income in a pinch. Usually people reinvest any dividends they receive or capital gains, but if in a pinch you needed some dividend income, it might be there. And then you get a lot of articles and stories out there about side hustles and side income and supplemental income to support primary income. And so these are all ways to sort of, alleviate the risk if something were to happen and it's going to hit your family. What are the things that you've done to be prepared for that and to reduce that risk?
Your point about diverse cash flows is well taken here, of course, but I want to pick on something that you said about debt, because one of the things I've heard is that if used properly, borrowing to invest can potentially be a very powerful way to grow your wealth. And of course, you would want to be doing that at a time when the markets are going up, right? And you get the most benefit from it. So what would you say to a skeptic who says, like, look, why wouldn't I want to take on debt when times are good, ride the good times while they're going, and then I'll adjust when I have to when things turn south?
Yeah, it's going to be too late if you try to adjust when things go south. So if you're borrowing money for a mortgage or for credit card debt or whatever, if you borrow money today and you're investing, then you're already borrowing money to invest. And there are good ways to do that, or better ways to do that, a mortgage being one of them. Or if you wanted to borrow money to buy a rental property or cash flow, that could be a good use of debt. But I don't recommend people borrow money to invest, and borrowing on margin. That's just not something that I have done, and I don't recommend people do that. I really think it's the opposite when the stock market's going up and up and up, and it feels as though, or some of the metrics align with maybe some overvalued compared to previous history. That's not the time to be borrowing money to invest, if you're even going to do that. So that's one way to really put yourself at risk, is to use margin for investing.
Right. So if you have the gumption to do it and take it on, you might want to do it after the markets fall a lot, right? And then benefit on the ride up. That's what I'm taking away from what you're saying.
Yeah, but again, I wouldn't say do that at the bottom, because if you're borrowing on margin, you're trying to guess where the bottom is. You're not going to guess where the bottom is. It's very hard to know that. So that's just not something I would recommend doing at all. Stock investing on margin is just not something that I do.
Okay. So it sounds like you've got a little bit of a conservative bent there. And speaking of conservative, one of the points that you noted in your blog post, I should say, is that investing conservatively, can be one way to reduce your personal financial risk. The flip side of that, though, would be that if you're too conservative, you run another risk, and that's not earning enough return to reach your financial goals. So how do you think somebody might want to strike a balance between those two things when times are good, in preparation for the next shoe to drop in the market?
Well, this all comes back to asset allocation. Have an appropriate asset allocation for your risk tolerance. And if you are someone who doesn't think there's going to be any problems in the future, then maybe you're all in. Or if you're younger and you don't think you need to have any downside risk and no exposure to lower risk assets like bonds, then you would have a 100 stock to 0% bond ratio. But as you get older, and we try to have this asset allocation that is a little bit more tailored toward having bonds in that portfolio, and that appropriate mix of stocks and bonds combined with your risk tolerance is how you right size. If it's not conservative, it's right size your portfolio. After a year or two of a bull market, your portfolio is going to get out of balance. And so sometimes the market goes up 2-3 years in a row and people don't rebalance. I recommend an annual rebalancing to bring your asset allocation down to the appropriate level, but it can get out of hand where the stock market keeps going up and your exposure to stocks becomes a little higher than maybe you want it to be. And that's where the annual rebalance for asset allocation comes into play.
Right. So stick to your overall plan through good times and bad times, whatever your asset allocation is that you're comfortable with. Try to stay on that path is the key that I'm taking away from here. And you mentioned sort of diversification being an important part of that, stock and bonds and stuff like that. One of the things I've seen a lot of people talking about is diversification into alternative assets, things that can help blunt the impact of a potential market crasher, because they're not as correlated to your traditional stocks and bonds and stuff like that. I'm curious, how are you diversifying your portfolio in preparation for the next financial crisis that we don't know when it's going to happen and we don't know what's going to cause it?
So last year, in late 2024, I remember reading articles about why bother investing in international stocks when the S&P keeps beating international stocks every year. And this year, that sort of reversed a little bit. That the international stocks have performed better, at least at the beginning of the year. I haven't checked in a while. But there is diversification is there for a reason, and we can get blinded by, say, the S&P 500 that it's performing, or the QQQs. So that people say, well, the Nasdaq is going to outperform, tech stocks outperform blue chips, and so there's always these trends that might make us question our best practices, like diversification. You mentioned alternative assets. There are more and more options for alternative assets now. They're easier to access through technology and loosened regulation. So with ETFs, you can buy commodities, or with crowdfunding laws in America, I'm not sure about Canada, but in crowdfunding laws in America, you can buy into real estate, larger real estate purchases like commercial real estate or Airbnbs. You can buy just a small stake. There's opportunities to invest in venture capital. That'd be a pre-IPO company or a late-stage startup company. And there's even some new regulation opening up private equity in the United States for diversification and for our retirement accounts. And so there are a lot of assets out there beyond stocks and bonds, and some of them are more or less correlated to the stock market, but others are not. And there's some portfolio theory. The 60-40 was sort of the traditional portfolio theory that financial advisors used for decades and still use today. But there's also the 50-30-20 portfolio, and that's stocks to bonds to alternative assets. And so more and more the idea of alternative assets are coming into the conversation. And I think they should, because these assets typically perform well and they're just easier to access now.
Yeah, no, so it sounds like if you are going to go that route, just make sure that you're actually getting diversification from them. You're not investing in alternates that are still pretty lockstep with your other stuff, right? Like, because then you don't really get the diversification benefit.
Well, that too, but also there are fees you have to understand, and you need to understand the assets, especially this. If private equity is coming in, there's going to be private equity investment vehicles coming into 401ks and available to investors, and so making sure you understand what's behind those assets and how they work. You shouldn't be investing in new assets if you don't really understand them. So not just throwing your money at these new shiny objects, but really understanding the investment. And if you're looking for diversification away from the stock market, then understand how these new assets or different assets correlate to market moves.
Mm-hmm. Okay, so that was step one in the process here. Your second step is building a cash savings in what you call an opportunity fund. Why do you think this is so important in your view?
Well, this isn't important for everybody. So this is more important if you do want to take advantage of a crisis or opportunities. So most people are going to survive a crisis or a uncomfortable economic times. They're going to survive it just fine. There's going to be a lot who struggle, but there's going to be a smaller proportion of people who actually take advantage of the crisis. There's a old Winston Churchill quote or a Chinese proverb about never miss a good crisis, something along those lines, right? If you feel strongly about wanting to take advantage or looking for investments where you can generate alpha, significant return above market returns, not just with the stock market, but it could be any kind of investment. The way to do that is with an opportunity fund. We have what we call our emergency fund, and that's people have different levels of comfort for emergency fund. They say 3 to 6 months, but when things go sour, it's too late to adjust and to start selling assets. If you start selling assets to generate cash, then you're probably too late, and it's not a good time to sell when things are falling and you don't know when the bottom is. So the way to prepare is to have cash available. Cash is king, right? And you look at Warren Buffett's portfolio, he's got something like $350 billion in cash just sitting there waiting. Now, we shouldn't be acting like Buffett. He can do what he wants, but when things went sour, he had the cash to move. And if you don't have cash to take advantage of these price disparages, where you might be able to get a discount on a specific asset that you're targeting, if you don't have cash, then you're not going to participate. 2007, back when my condo value tanked and I was paying a very high mortgage, I didn't have any cash. And for the next 3 or 4 years, there were lots of really good opportunities to invest in real estate in my area, which is the Northern Virginia suburbs of Washington, D.C. And I saw very experienced investors taking advantage of those deals, but the rest of us were just on the sidelines, hoping to keep our home and hoping to keep our jobs.
Now, I hear what you're saying about the opportunity fund. Maybe you can scoop up things, on a low here or something like that. But the flip side to that, to play devil's advocate here, is that cash can be a drag on your portfolio, right? It's not going to earn you the same kind of returns as other investable assets here. So, for you, how do you strike that balance? Like, how much do you think makes sense to hold in an opportunity fund where you can sacrifice some of that immediate, expected return that you're going to get by sitting in cash?
Well, for a long time, their cash was not paying much, and with inflation, you were probably losing money on a lot of cash. A lot of the savings rates were below 1%. There are higher yield savings accounts and various vehicles you can use in your brokerage account to have a 4 to 5% low risk or no risk yield. So there's when the long-term stock market returns are 9% and you can earn 4 to 5% in cash, it's not that big of a difference, right? It sounds like you're in cash, but as long as that cash is earning more than inflation, which for most of the time it is, there was a period there where it wasn't. But if cash is earning that yield and the stock market is sticking to its long-term returns, then it's not that big of a spread. And the balance there is you might sleep better at night. There's having cash on hand does give you these benefits of sleeping well at night, having flexibility in your financial life. Maybe you could go and do something for fun with the cash, or you could save up for maybe a business opportunity that's in your local area. There are a lot of options you have when you have cash on hand, liquid cash, that those options aren't available to you when asset prices fall, or even when you're just looking for opportunities. So cash is there's a trade-off, and you don't want to have all of your assets in cash, but especially for older people, who need that money to live off of, it's good to have it. And with yields at 4%, it's really not that far below market returns a lot of years.
Yeah, I mean, it's certainly become more attractive in recent times, no question about that. I'm curious, just quickly, is there like a percentage that your opportunity fund represents out of your total portfolio that you think is maybe a good rule of thumb for people to consider?
I don't have I would say somewhere around 5%. So I say that it's okay to speculate with 5% of your wealth. Certainly most people, it's going to be below that. And it depends on the type of asset you're maybe interested in buying. If you're a real estate investor, for example, and there's a certain amount that you're going to need for a down payment in your locality, then you're going to know how much you need. If you're just someone who's trying to pick up NVIDIA stock down, then it really doesn't matter how much you have. But I have about 5% of my investable assets there for speculation, and so that's how I think. Most of my 95% of my invested assets are boring and in just index funds or really low volatility stocks. But I think about 5% is the number that most people are comfortable with if you're intrigued by investment opportunities that might be timely.
Right. And step 3 also kind of plays in the opportunity fund here, but we're going to get to that in just a moment. I just want to take a quick pause in the action. A little bit of fun, okay? I have a trivia question for you in the audience that I want you guys to weigh in on, okay? Trivia question goes like this. The S&P 500 has crashed by at least 20% a total of 13 times between 1950 and 2024. How long on average has it taken for the index to recover? Okay, is it about 6 months, about a year, 2 years, 5 years? I'll let the audience sort of weigh in silently in the background here, but Craig, you want to venture a guess here?
Well, I think I knew the answer. I actually thought there would be more in that time frame, but I think it's somewhere around 2 years or so on average.
Yeah, you got it. And we got the answer up there for you here. It's about 2 years. Actually, it's closer to 2 years and 2 months, at least according to data from Clearnomics and Standard & Poor's. Of course, there's a big range of recovery times within that that we need to consider over time, right? Like, it doesn't always snap back as quickly as we saw in COVID, which I think was a record snapback time. Somebody in who went through the Great Depression, for instance, like that took a real long time. So when it comes to market crashes like that and the recovery time, how do you think about that when you're investing, Craig? Are you trying to just kind of look through that and just continuing on, or do you try to do something differently when there's moments like that in the market and you know that you might have to hang around for a little bit waiting for the recovery?
Throughout my career, I was always investing. I was just, you're always investing through an employer plan, or if you can dollar cost average into an investment over time, I really think that's the way to do it. With the magic of dollar cost averaging is when assets are higher, you buy less, and when assets are priced lower, then you're buying more if you're investing in a consistent time frame, the same amount. So dollar cost averaging is really the way to go. When there's been market downturns in the past, there may be an opportunity to buy more. If you like stocks, if you like the market for the next 10 to 20 years, and you liked the market at all-time highs yesterday, and the market's down 10% a week later, then you probably still like the market as a long-term investment. As long as your investment thesis on the market or the economy as a whole doesn't change too much. So when the market falls, I have no problem with taking some cash that you have allocated for either an opportunity fund or something else, and to put that into the market. It's not, I would say, buying the dip. It's more just, hey, if you like this asset long term and there's an opportunity to buy it cheaper, I don't have a problem with that. But not in lieu of your consistent investing. You don't want to be just trying to wait for the market to crash or fall and then buy then. You want to be always investing, because the market can keep going up for a long time. If you remember back to 1996, Alan Greenspan famously called the market in an irrational exuberance, but the market continued rising for another 4 or 5 years after he already mentioned that. And so the stock market can remain overpriced for a very long time. And another thing to think about, and I don't think this gets a lot of attention in the mainstream media, but you have a lot of new investors over the past 20 years. These investment apps and online trading and phones and all that, and zero fees. You have this huge wave of new investors that have come in and increased the value of the market and stocks. And if you're comparing now to, say, the 1930s and 40s, it's just a very different market and economy. And so as more access opens up for more people and retail investors, it's going to be interesting to see how the next market event would transpire.
Yeah, certainly. I think there's no shortage of investors out there who think like this is pretty easy to look through market volatility. And that's easy until it's not, right? There have been some pretty nasty times that we have to consider in the past year, and who knows what's coming down the line. In any case, Craig, we got a lot more to get to here, but just before we continue, just a quick shout out to our viewers here to follow TD Direct Investing on YouTube, Instagram, and Facebook if you're enjoying the show so far. And another programming note too to put on your radar here. In October, we've got Investor Education Month happening for the whole month here. We got a ton of exciting content that you can find out more about on our socials here, and we've also got a really exciting contest. Let's find out more about it.
The Investor Education Contest, brought to you by TD Direct Investing, is officially live. Canadians can enter today for a chance to win a check for $7,000 and a 1-hour private educational session with a TD Direct Investing client education instructor. There are 3 ways to enter. Visit the TD Direct Investing Facebook page, click follow, then like the contest, post dated September 10th, 2025. Follow TD Direct Investing on Instagram and like the contest, post dated September 10th, 2025. Or attend a TD Direct Investing Investor Education Month workshop. Learn how to register at td.com/IEM. You can enter once using each method. The contest runs until October 31st, 2025. Scan the QR code for full contest rules and details.
Awesome contest. Make sure you check it out here. All right, Craig, let's get to the third step in your process here. Kind of builds on what you were talking about with your opportunity fund here. Step 3 is to identify ideal assets you want to buy when the time is right and the doomsday prices, let's call them, that you'd pay for them. How do you go about doing that?
Well, I think the good example here is real estate. And when you're doing cash flow analysis of a real estate rental property, let's say you want to own a rental property, a lot of times when people want to buy those properties, they run the numbers and the numbers don't work, right? And so, in your analysis, you look at the numbers and say, at what price would this investment work, and at what interest rate would this work, and how much down payment would this scenario work to buy this rental property in this location? So that's the way to think about it. If the housing market is too expensive in your neighborhood for a rental property, then at what price coming down would that become more attractive? When it comes to the stock market, usually these crises change the game. So when COVID hit, we didn't know what was happening. There was uncertainty in the market. The market really hates uncertainty, and I think the market came down something like 34%. And most of us were investing dollar cost averaging through an employer plan, or just, you put your money to work, and as the markets come down, you're still buying it. But what happens is the market comes down usually faster, much faster than it goes up. And so on the way down, there's this fear of buying and it's go further, catching the falling knife. And one way to alleviate that, the behavior risk that you have there, is just to pick levels where you'd be comfortable putting more money into it, whether that be 10% or 20% or just on the way down. And that's how I did it when COVID hit. When the market was going down so fast, I said, well, I'm going to put a little bit more in at 20, a little bit more in at 25, and just took some of the emotion out of it by setting those limit purchase numbers. Now, I wasn't trying to time the market here. It was just, wow, the market's on sale, and that's where I want to invest my money. And so trying to use some bit of structure to handle that sort of event in the case. You don't want to, if you want to own that asset for the long term.
I hear what you're saying about, trying to like pick your spot a little bit here. It's not pure market timing, but it's also not dollar cost averaging either. Like it is a twist on that. And I want to play a clip for you from blogger Nick Majuli, who we spoke with a few months back here. He actually found that this strategy doesn't really outperform dollar cost averaging, this buy the dip type kind of strategy, whether you're doing it in like a structured fashion or not here. He had a great quote. He said, even God couldn't beat dollar cost averaging here. Let's hear his rationale.
People are like, oh, market's too overvalued. I'm going to wait till there's a dip in 2017, right? And what happened is there wasn't a big, there was a very small dip at the end of 2018, but it wasn't a major one. And then 2019, there wasn't a dip. The first big dip we had was March 2020. And guess what? If you had bought on the exact bottom, if you could perfectly time it and get the exact bottom in March 23rd, 2020, you would have bought at prices 7% higher than the beginning of 2017. And that is the reason why buying the dip doesn't work. Because even when I give you the perfect dip, I give you the information ahead of time, you perfectly time it, and still on average, you would have paid more than if you had just bought, many years ago and just kept buying over time.
So to me, Craig, it kind of sounds like Nick is sort of pushing back in some sense against this idea of an opportunity fund that you have and buying at lower levels rather than just kind of investing your money right away here. What would you say to kind of counter what his line of thinking is here?
Oh, I love Nick's blog. I've been a long time reader, and he uses data to tell his stories, and I really like the way he's always used data. And in that case, he's talking about dollar cost averaging versus buying the dip with in lieu of dollar cost averaging, right? And so I'm not saying stop dollar cost averaging and just wait for the dip. This is more of continuing that buying spree and just continuous dollar cost averaging investing. But when there may be an opportunity and you have cash, that there's places to put it, and if it's in the market, that's one place to put it. If you like the long-term outlook for the market. And when it's down 20 or 30%, and like you said with the data before, is that on average, it's about a 2-year recovery. And so we saw that in 1987, the stock market crashed, but then it came back not too long afterwards. So this is not about trying to time it right and trying to buy the dip. It's just when an opportunity presents itself and you have cash that you wouldn't be putting in, you're already investing as dollar cost averaging investor. There may be an opportunity to buy things at a discount if you like the long-term prospects of that asset.
Right. Kind of sounds like you're trying to take a sort of almost like a middle of the road approach here. You're doing a little bit of this, a little bit of that. I guess that in itself is kind of like a form of diversification, if you want to think about it that way, right?
Sure, maybe.
Okay, let's get to the fourth step in your process here, and that's, to your point here, continuing to invest as normal before the next financial crisis hits. Okay, you're not trying to reinvent the wheel here in preparation for something. So on that note, what do you think are some of the good investing habits, certainly that you've adopted, that you feel others should take to heart?
Well, always be investing. Just it's a lot. It's easy for people who are employed, right? If you have an employer, and for us in the U.S., it's a 401k, and you're just consistently getting a paycheck, and some of that money is going to the market. That's how I built most of my wealth over the last 20 years, and you can set it up. It's automated, and it works really well. And you buy when things are high, you buy less. When things are lower, you buy more, because it's just that consistent investment. So that's what most people should be doing, right? Now, the other thing I think about is that we don't want to be rooting for a crisis, right? Like, we don't want to be sitting around like, oh, I hope there's a crisis so I can, buy that real estate property or get into Nvidia at a lower price. You don't want that to happen, because if there's a crisis, things go bad and there are unintended consequences and people suffer. And so I occasionally I'll see people on social media saying, oh, I can't wait for the next downturn so I can buy for the long term. And that's just not a good situation either. On the personal finance side, it's all about reducing your risk, and the habits that we could think about are, when your economics improve, don't go out and spend it on something new. Maintain a reasonable lifestyle and not too much inflation. That's when I got into trouble. I got a big raise back in 2006, and I thought, I'm going to turn this around. I'm going to buy a place. And it would have been much better if I would have just saved more money instead of taking that money and putting it toward something that would give me a big debt payment.
All right, so some fantastic foundational concepts here to think about that we talked about here, Craig. Really appreciate you filling us in on your 4-step process here for preparing for the next financial crisis. And just a reminder to our viewers here, if you want to get in on this conversation and you have questions for Craig, we want to hear them, so make sure you submit them to us. Again, if you're watching on Webworker, you can use the chat box to send your questions to us. On our broadcast platform, it's the questions and comments box, and on our YouTube live stream, you just got to click on that link in the description and ask your question in our broadcast platform here. Now, before we get to that Q&A, though, I want to bring in my colleague, Caitlin Cormier, who's going to show us some of the ways that we can put some of Craig's preparation process into action on the Webworker platform. Caitlin, welcome to the show.
Hey, Rob.
All right, so show us, how can investors track, let's say, price movements of stocks and ETFs that they'd be interested in buying when the market crashes and they want to take advantage of that opportunity fund that maybe they created?
Absolutely. I mean, when we think about this, obviously we want to be on top of those prices falling, but like you said, you can't spend your whole life being worried about this and watching the stock constantly. So one of the great tools we have on Webworker is called alerts. So you can actually set up different alerts for different prices as stocks fall. So let's hop into the platform and see where you can do that. So we're going to go ahead and click under the research tab, and then under tools, we see kind of the second last one here is called alerts. So we're going to click there. And so we have the opportunity here to just go ahead and type in whatever security it is that we're looking to set the alert for. So let's just I'll just type in Google here, for example. So you'll get this to pop up, and what it'll show you is that you can set a number of different types of alerts. Now, of course, in this case, we're talking about maybe the price dropping to a specific level that we've kind of set as that doomsday price, or around that area, or whatever kind of metric we want. But there's also things like if we want to see if it's trading a lot or any other metrics maybe that have changed. But specific to this scenario, we could go ahead and click and say, yep, we want to know if there is a price drop for this particular stock. So maybe if it goes to 225, maybe I'd like to receive a notification. You can also add a note to yourself just to, let you know, like whatever the high was. Maybe this is some sort of a percentage. You can kind of make a note of that. And you can also receive push notifications on your cell phone if you'd like to be able to be notified. Just make sure that you always have the most recent version of the app installed on your smartphone so that you can get those alerts. So then once you're good with that, just click save. They'll go ahead and show up right here within your alerts kind of dashboard. And you can go ahead and add as many alerts as you would like there at any time.
I like that note feature because, when things are, hitting the wall, let's say when the market is crashing, you might have a million ideas pop around in your head. It's nice to have a note there that says, oh yeah, that's why I wanted to do that. Okay, cool. Maybe I'll jump on that. So great feature there. One of the other things too that jumped out to me about what Craig was talking about was this idea of buying assets that you're interested in increments as they fall in value. So you're sort of doing some dollar cost averaging there to an extent here. How could an investor sort of automate that process a little bit in Webworker?
Yeah, absolutely. I mean, dollar cost averaging is one thing when you're doing on a consistent basis. You can be always contributing, on a regular contribution. You can set that up through our transfers portal, just kind of making it a recurring transfer. But if there's specific price points that you have, like to actually get into the security as opposed to just contributing to your account, then let's go look at what limit orders look like under the buy sell tab. So from within WebBroker, if you're on a security, you can always hit the buy button here, or you can hit way up here on the top right hand side where it shows kind of the buy and sell arrow. I'll just go from here since we're here already. So we are going to be under the stocks and ETFs tab here. And all we have to do is simply, instead of clicking market, we just click limit. So what limit does is it says, this is the most that I'm willing to pay in order to get into this particular security. So again, maybe if 225 is one of the prices that we've kind of identified that we want to get in at, then we go ahead and set a limit order for the price of 225, the number of securities, maybe you want to buy 50 shares at that price. And then the key piece here would be to make sure that you put it for an extended period of time. So if you only put the order in for today, the chances of this stock, I mean, maybe something crazy will happen, but that's a huge drop for it to take in one trading day. We're probably looking at a longer period of time. So in that case, you could put it, for example, good till cancel. That'll be in effect for 180 days. So then you sort of only need to kind of set them up every once in a while. You're not constantly having to kind of re-enter these orders. And you can set as many of these as you want. If you wanted to have, for example, one at 225 and then one at like 210, you can go ahead and put those orders in on the system. Just keep in mind that there is a bit of a hold on the account. Like you just have to make sure that you have some cash available and that sort of thing to move forward with the purchases if you are putting a bunch of these orders in place for kind of large sums. So you just want to make sure that you have the cash available to sort of liquidate if any of these do actually go ahead and become active orders.
Right. Okay, good. That's a good point to know here, Caitlin. Thank you for filling us in on that. Always appreciate you showing us the ropes on the WebBroker platform here. We'll see you next week as well. Thanks so much.
Thanks, Rob.
That was TD Direct Investing's Senior Client Education Instructor, Caitlin Cormier. Okay, Craig, it is time to open up the floor and take some questions from our viewers here. Let's see what we got on tap for you here and what our viewers want to know more about. This first question comes to us from Ram Nikal. Hope I said that right. He says, asset allocation rebalancing can trigger capital gains or losses. How can these be minimized? Do you have any ideas for him?
Well, yeah, if you're doing this in retirement accounts, we don't have that problem. And so I think most people are doing this in retirement accounts. But if you have taxable accounts, you have to be much more careful. If you have stocks that have long-term gains or even short-term gains, and you want to be careful to sell those. And actually, that was the topic of our very first conversation, Rob, back, I don't know, about a year and a half ago. I was simplifying my portfolio for retirement, and a lot of that has to do with some stocks I own in taxable accounts. And so there are ways to minimize taxes by selling losers, the companies that aren't doing well in your portfolio. Or lots that have a higher cost than others. But yeah, you have to be very careful in taxable accounts. In retirement accounts, it's not a big deal. You can also rebalance in the retirement accounts, taking into consideration your taxable assets as well. And so when you may have do more rebalancing in the retirement account versus the taxable account, so you can kind of balance things out that way.
Okay, that's a good thing to keep in mind there. Yeah, I mean, it's always a little bit of a dance around the tax things there, but certainly you can use some of the capital losses to offset some other big capital gains too and help minimize the overall tax hit to some degree here. Okay, we have a question coming to us from Stephen. Let's get to that here. Stephen's wondering, for fixed income, is there a short list of favorites you prefer? Now, of course, we can't give specific investment advice here, but that said, Craig, are there any sort of types of fixed income products that you generally like, perhaps in this environment of volatility and uncertainty that we're in?
Yeah, I use very, very broad bond index funds from the large providers, and I don't really experiment too far beyond those. I do have some short-term cash that have some bonds in them, so I stick with index funds, and I don't do much with fixed income other than own those, either mutual funds or ETFs.
Okay, so keeping it simple, keeping it easy, keeping it broad-based. That's a good thing to keep in mind here as well. All right, Carolyn's got a question for us. Let's get to that one. Carolyn's wondering, where would you recommend putting cash to earn a 4 or 5% yield? Now, we did talk a little bit more about the returns on cash here, Craig. Maybe you could expand on that thought for Carolyn.
Sure. Well, rates just went down yesterday, so I haven't looked at least the federal funds rate went down yesterday. I haven't looked at cash rates, and so I've been seeing 4%, 3.75 to 4% in just regular old bank savings account, online savings account. If you walk down to your local branch, you're probably not going to get 3, 4, 5% yield on cash. That's just the way it is. But there are online banks that typically offer better terms. Also, within your brokerage account, there's often a cash sweep that you can just set up and automatically put your cash into a higher yield account. Depends on what broker you're with, or you guys have broker. Maybe you have a sweep account, but I found that the sweep account from my brokers work very well with giving me a decent yield on that cash.
You know, one thing I just want to throw at you here, Craig, because, you know, speaking of like Fed funds rate and stuff like that, one of the things I've heard people wondering about is, could there be a return of stagflation? And inflation could be quite high. And if you're in fixed income products, you're going to take a hit on that. You're probably not going to be earning enough income to offset the inflation. Is that something that you think about that's top of mind for you right now?
It's not something I think about a lot, no. I mean, when inflation was going up, I think I was in the same boat as everybody else. That just things were getting more expensive, and that hurts. And so you tighten things down, and no, but it's not really from an investment standpoint how I think about it. Yeah, I'm investing long term, and so I'm in stocks, I'm in bonds, and I have some cash, and I have some real estate. But it doesn't really change the way I operate, even if the inflation or stagflation is not in our favor.
Right, so just trying to keep the big picture there. Of course, over the long term, at least historically, stocks have been the best way to beat inflation, I guess, over the long term. Okay, let's get to our next question here. This one is coming to us from RA. They're saying, I'm concerned that President Trump's potential tariffs and rate cuts could fuel inflation and weaken the US dollar. How might this affect other currencies, particularly the Canadian dollar? We've recently sold a significant amount of real estate and are holding substantial cash. Now, I'm going to put your currency strategist hat on here a little bit, Craig. Do you think this is something that you could address for RA?
This is not something I can really comment on. I will say that I went to England and I kept watching the dollar fall as I was booking my Airbnbs, and it kept going down and down, and it's not a very good feeling to see your currency falling like that. And I traveled a lot in my 20s, and when the US dollar was really strong, and that was a great time to travel. So when I think about the dollar and currencies, I just think about, is this going to be a good time to travel? But I don't have any insight onto what the tariffs are going to do to the dollar, other than they lowered the dollar as I was getting ready for my trip overseas, and it made it more expensive for me.
That's Murphy's Law, right? It always ends up that way, right when you book something. Okay, we have time for one more question. Let's get to it. Let's see what we got on tap here. Sukhdeep wants to know, is it a good idea to borrow against my principal residence to invest in a rental condo? Since I'd be borrowing to invest, what's the maximum amount or percentage you would recommend? Now, Craig, you had said earlier you're not a fan of borrowing to invest, but with the real estate lens on, what's your thought there?
Well, I'm not a fan of borrowing from a margin account to invest in stocks. I do like real estate. I'm not a real estate investing expert, and I sort of rely on friends of mine who are really strong in that if I would be exploring something like that. That question is really dependent on how much is in the property. It's really just too dependent on what's out there. Would I say definitely not? No. But if the numbers work out and it looks like you can get good terms on the loan and it makes better sense than getting a fresh loan, then it could be something to consider. But it really is dependent on the deal itself, and I can't comment on that from that question.
Yeah, certainly, and it probably depends too, like how prepared are you elsewhere in your financial life to, take on a potential hit if that real estate deal went poorly, or you had a little bit of a rough patch, right? Like there's a lot of factors at play here that would go into a decision like that.
Exactly. Yeah, there's just we don't have enough information for that question to give an answer. It's not a no, but for it to be a yes, the numbers would really have to work out, and you'd want to make sure it was the right move from a rental cash flow perspective and interest rate you can get and all that, and versus alternatives that might be out there.
Right, okay, there's something to consider, but to consider carefully, obviously. Okay, Craig, we appreciate you fielding some questions from our audience here. It was great chatting with you. We appreciate you taking the time to speak with us and share your perspective on preparing for the next financial crisis. Really look forward to having you on the show once again down the line.
Thanks a lot.
And for those in our audience, of course, thank you for tuning in. We always love to have you here. Make sure you check out next week's episode. We're going to size up some of the most popular retirement income strategies with a seasoned financial planner. Is the one you're considering all that it's cracked up to be? Well, you're going to have to watch to find out. That's all the time we have for this edition of the show, though. For everyone at Inside Investing, thank you so much for watching. We'll see you all next time.
Have more questions? Check out the links to the right and in the description below.